Penny stocks are a controversial topic in the world of investing. Often seen as an opportunity to make quick gains, these low-priced stocks, usually trading for less than $5 per share, are tempting for beginner investors looking to turn a small amount of money into a fortune. But the truth about penny stocks is much more complicated, and before diving in, it's important to understand the risks involved. While the potential for high returns can be alluring, penny stocks are notoriously volatile and can lead to significant losses just as quickly. Knowing the full scope of risks is crucial before deciding whether they are the right investment for you. At first glance, penny stocks may seem like an appealing way to enter the stock market. Their low price means you can buy a large number of shares with just a few $100s. For example, if a stock is trading at 50 cents, you could purchase 2,000 shares for just $1,000. If that stock's price doubles, you would make a 100% return on your investment, seemingly overnight. The potential for huge gains in a short period of time is what attracts many to penny stocks. However, what makes penny stocks attractive is also what makes them extremely risky. These stocks typically belong to small, obscure companies that are not well known and often have limited financial stability. Unlike major corporations that trade on large exchanges, like the New York Stock Exchange, NYSE, or NASDAQ, penny stocks often trade on the over-the-counter, OTC, market or pink sheets, where reporting requirements are minimal. This lack of transparency makes it difficult to evaluate the true value and prospects of these companies. Because they are not as closely regulated, penny stocks are more vulnerable to market manipulation. One of the most common schemes is known as a pump and dump. In this scam, promoters artificially inflate the price of a penny stock by spreading false or exaggerated claims about the company's potential. As more people buy the stock, its price soars. Once the stock reaches a peak, the promoters sell their shares for a profit, causing the price to crash and leaving ordinary investors with worthless shares. Many new investors fall victim to these schemes, losing their hard-earned money in the process. Another significant risk with penny stocks is liquidity. Liquidity refers to how easily you can buy or sell a stock without affecting its price. In larger, well-established companies, there are usually many buyers and sellers, making it easy to trade the stock. But with penny stocks, there are often fewer participants in the market, making it harder to find someone willing to buy your shares when you're ready to sell. This can lead to situations where you're stuck holding onto a stock that is rapidly losing value, unable to sell it before the price drops further. Additionally, penny stocks are highly volatile. Because of their low price, even small fluctuations in value can lead to large percentage gains or losses. This volatility can be exciting when you're seeing green, but it can just as quickly wipe out your investment. Many people are drawn to penny stocks because they hear stories of investors who made a fortune. However, for every success story, there are countless others who lost everything due to the extreme volatility of these stocks. For those willing to take on the risk, research is absolutely essential. Penny stocks are not typically covered by analysts or major financial news outlets, so it's up to the individual investor to thoroughly research the company before investing. You should look into the company's financial health, management team, product offerings, and industry outlook. If a stock seems too good to be true, it probably is. A stock priced at just a few cents or dollars per share is often that way for a reason. Another key to navigating penny stocks is to manage your expectations and limit your exposure. Never invest money you can't afford to lose, and be prepared for the possibility of significant losses. Some experienced investors allocate a small portion of their portfolio to penny stocks, viewing it as speculative and high risk. By keeping your investment small, you can protect yourself from devastating losses, while still having the potential to benefit from a successful trade. If you're a beginner or conservative investor, you may want to consider other investment options. Diversified mutual funds, ETFs, or index funds can offer more stability and long-term growth, without the extreme risks associated with penny stocks. These funds allow you to invest in a variety of companies across different sectors, spreading out the risk and reducing the likelihood of a major loss. In conclusion, penny stocks can be highly profitable, but they are not for the faint of heart. The potential for quick gains comes with the very real possibility of losing everything. If you decide to enter the world of penny stocks, be prepared for a bumpy ride, and make sure you thoroughly understand the risks before investing. For most investors, a more diversified, long-term approach to investing is likely to be a safer and more rewarding path.